Hi, everyone. This is Ela Lange, co host of the Dollars with Sense radio show and podcast, here with my fellow financial guru, Terence Vanderwood.
Hello, everyone. Thanks for joining us. Comprehensive financial planning is our passion, and helping people grow and protect their wealth is our mission. We're back this week with another important discussion around permanent life insurance. You may remember we talked about whole life insurance in our episode called Send Junior to Uni, when we referred to the money tree concept, where the apples on the money tree are the cash values available to pick off the tree after your investment has grown over a 20-year period.
Yes, and it was a fantastic complement to your children's RESPs when you begin your financial planning around their education. Today, we'll include a look at what universal life insurance has to offer. Both provide a rock-solid lifetime coverage and tax-advantage cash growth opportunities, but they're structured differently. So knowing what these differences are and how they could affect your portfolio are important considerations when choosing which one best suits your needs, your risk profile, and your comfort level.
As usual, we tried to keep our explanations as simple as possible so you don't get scared off because the topic is about life insurance. Ella and I want to show you how you can use life insurance as another asset allocation to grow your wealth. And who doesn't want to know more about how to make their money grow, right?
Right. So for the next 15 minutes or so, we will be discussing options one has to develop a rock-solid foundation in your financial plan through permanent life insurance. Whole life versus universal. Both permanent insurance policies with certainly common features, but major differences as well that you should know about that will open up options you may not know have existed out there to help you grow and protect your wealth.
Just for fun, I was curious as to how far back in time people had been using life insurance in their overall planning. Apparently, according to my research, the sale of life insurance in the U.S. began in the 1760s. The Presbyterian synods in Philadelphia and New York City created the Corporation for Relief of Poor and Distressed Widows and Children of Presbyterian Ministers in 1759. So what's that acronym? It's CRPDWCBM. We find that funny because we're financial planners and we're always inundated with acronyms. So excuse us for taking a little personal moment there. So in 1759 is when this corporation was created. Episcopalian priests organized a similar fund in 1769. And between 1789 and 1837, more than 24 life insurance companies were started, but fewer than a half a dozen have survived.
Amazing. So that's over 250 years ago.
Crazy, I know, but it goes to show you that the need has obviously always been there, and the industry has grown and evolved with the times. We'll show you a chart a little later on regarding the history of rate of returns. One of the companies we represent in particular has offered over the last 25 years, regardless of events that have negatively or positively influenced the markets. But first, Ella, talk to us through the features that exist in both whole life and universal life.
Sure. So, very easy. Both participating and universal life insurance offer permanent, lifetime insurance coverage. Universal life insurance offers flexible payment options of 10, 15, or 20 years or life. Participating life insurance offers a guaranteed payment period of 20 years. Now, both options allow you to use the money within the policy to pay for your insurance. And both participating whole life and universal life insurance offers a guaranteed death benefit, which is the basic amount of life insurance you purchase.
Okay, so both have lifetime insurance coverage, guaranteed premium options, and guaranteed death benefits. Here's where they differ. The participating account assets in a whole life insurance policy are chosen and managed by experts within the insurance company. They are professional asset managers providing competitive participating account returns with a focus on stability. A universal life insurance allows you to manage your risk profile and choose investment options within the policy. So if you're looking to invest, you're able to select the investments in your policy according to your risk profile, giving greater flexibility in how and where you invest within the universal life insurance. Needless to say, the markets affect the returns on this type of policy. And on the flip side, in the whole life insurance, you can see a consistent and stable rate of return year after year.
Okay, so remember that chart Terence mentioned a little earlier. We're going to have that up on the screen here. And it's to show you what we have on rates of return from one of our insurance companies that we'd like to share with you. Even during economic uncertainty, for example, Canada Life's participating account dividend scale interest rate has been relatively stable compared with many other financial instruments and indices. So I'm going to go through some of these columns. We've got one with the Canada Life, so that's the dividend scale on the left, and then the S&P composite is next. We've got another column referring to the Government of Canada's 5 to 10-year bond rates. The next column will show a 5-year GIC return. So in 1982, 83, and so on, it was nice and high. And as the years have progressed, obviously they've gone down quite low. And the final column will show you a consumer price index. We've taken a snippet of what the last 30 years look like. Year after year, the return table from this Canada Life dividend scale interest rate performance has maintained relative stability in comparison with the S&P TSX Composite Index, compared to the Government of Canada long bond interest returns and the Consumer Price Index.
Let's keep looking at the chart, and we're going to look at specific years. So see how the recession in 1990 and the dot-com bubble popping in 2000, the 9/11 tragedy in 2001, and the recession of 2008 affected the composite or affected the markets. So the second column that you see there is the S&P and TSX composite. That's the market. That's Canadian market returns. So for instance, if we look at 2008, the Canada Life dividend scale had a return that year of 7.71%. Again, a reasonable rate of return for almost all investments would be considered around 7%. You can see that the market in the next column actually returned a negative 33. That was the big financial crisis that we had just a few years ago. The bonds, the Canadian bonds, returned 3.3%. The 5-year GICs returned 3.01%. And the Consumer Price Index, which basically measures in parallel the cost of inflation, was 1.16%. No one can guarantee those rates. The rates of returns of 7.71% in 2008, no one can guarantee those rates with mutual funds or with stocks, and not even Warren Buffett can do that. You know what? In matter of fact, Warren Buffett probably owns quite a few of the permanent life insurance because, folks, this is used very often by the wealthy as it is a very smart way to grow your money. But it is also available to all of those who wouldn't consider themselves the wealthy ones. For those who are the regular Canadians that we're giving out this information to.
So that's where you participate in the experience of the participating account, along with other policy owners, and may benefit from the earnings in the participating account through dividends. That's not the structure within a universal life insurance policy. Just to remind you guys out there, if we're going too fast, please don't hesitate to reach out and ask us personal questions relating to you and your family insurance needs, either by calling us on our number 778-879-0820. You can always write us to on our Facebook page. That's Dollars with Sense. You can send us an email at 2financialgurus. That's the number 2, financialgurus, all in one word, at gmail.com. And finally, listen to this podcast again and watch the podcast so you can look at the charts that we're talking about. Look us up on the YouTube search bar under Ela and Terence, and we will pop up there, and you can see this, as I say, and 40 other episodes discussing financial planning.
Yes, and while you're at our YouTube channel, please feel free to subscribe so that every time we create a new episode, you will get automatic notification about it, and you'll be able to glean the information that is best towards growing and protecting your wealth. So here's something to consider regarding your cash flow when choosing what type of permanent life insurance is for you, whether to choose whole life or universal life. If you have a consistent income, participating whole life insurance provides a guaranteed premium that's easy to budget for. If your income is cyclical, universal life insurance provides you with flexible payment options. You can pay more up front to compensate for times when your money may be tied up elsewhere later on.
Good point. And for all you savvy investors out there, if you prefer to be in control when selecting the investments in your policy, returns in a universal life insurance are based on the investments you choose from the options under the policy. So if you're more comfortable choosing how your money is managed, universal life insurance may be ideal for you. You can customize how and where your funds are directed. You're comfortable with more variability in your returns because of the potential upside in returns. You can be more equity-based in your choices. You can also choose a conservative or balanced weighting. Basically, the choice is ultimately yours.
A participating life insurance is like a fixed income type of asset. The investments in the participating account are invested to an approximate weighting of around 20% equities and 80% fixed income, providing the stable returns that we showed on the chart before. On the other hand, a universal life insurance will follow market volatility and therefore not have the stability as a participating life insurance. Okay, now Ella has a question for you all.
Are you paying too much to the taxman? Well, 42% of Canadians surveyed agree that reducing the amount of taxes they pay is an important, immediate financial goal. We've talked about the variety of strategies on how to reduce your taxes, as we are so preoccupied with the taxes we're paying now. But have you ever stopped and thought about the tax that will be owing on your assets to the taxman when you pass on? We're going to dedicate the next 10 minutes to inform you about the income tax liability your estate could incur without proper plans in place and some of your options to minimize and pay this tax. You may be asking why. Well, because you don't want to make the taxman a beneficiary of your estate.
Certainly not. In the eyes of the taxman, this is how it works, folks. You are deemed to have disposed of your property in the year of your death. This basically means that from a tax perspective, the government treats your property as if you had sold it as soon as you passed on the same day. For example, 100% of the value of your RSP or RIF will become taxable. Your personal representative or the executor or executrix, if it's a woman, of your estate is required to include the value of these plans as income when your tax return is filed for the year of your death. And this may, in all likelihood, put you into the highest marginal tax bracket if you're not already there. This could mean taxes in the 47% tax bracket, perhaps higher due to the clawback of the old age security pension. In addition, you will have to pay taxes on the appreciation in any capital property you own outside of a registered plan. A registered plan is an RSP, is a RIF, is a LIRA, is a TFSA, amongst others. So this appreciation on your capital property that you own outside of a registered plan is known as capital gains tax. So as of today, 50% of what you have earned on your capital property will be included or must be included as income on your final tax return and taxed at your marginal tax rate, Once again, this inclusion of income may put you into a higher tax bracket in the year of your death.
So I'm just going to give you a simple example of capital gains tax, Terence.
Okay.
George purchases a mutual fund for $100,000. The mutual fund is worth $200,000 when he dies. The appreciation in value is $100,000. 50% of that is taxable. George's personal representative, as we suggested earlier, must include that $100,000 as income and pay tax on $50,000 on George's behalf.
So let's just say that George that year made $40,000. He's a pensioner on a modest income. And at $40,000, he would be paying probably around 20% or 22% in taxes. But then they add on this $50,000, and all of a sudden he's making $90,000 a year in tax, which pushes him up to around 33% in taxes. So it makes a huge difference, folks. So focusing on capital gains for a moment, the following are examples of the types of capital property you may own that may result in capital gains tax either when you sell it or have due to have deemed disposition when you die. All investments, such as mutual funds and stocks and bonds, if held outside of the registered plan, may become a taxable event. We say may because of the rollover aspect, which we'll get to in just a moment. If you own a cottage, the increase in value may be taxable as well. Owning rental property, land, a business, including a farm and shares into a small business corporation, as well as any other appreciable assets such as antique cars or artwork, can all result in a capital gains tax when you die. The thing to remember is that you only pay capital gains tax if the capital property has increased in value since you purchased it, and if the asset is not bequeathed to your spouse or common law partner. I say that again, and this is key, that we referred to earlier, that if the asset is not bequeathed to your spouse or common law partner. A tax-deferred rollover of a farm property to a child may also be possible, but that's specifically for farm property. If your property has declined in value, you will have a capital loss, which can be used to offset other capital gains you may incur on other property. Capital losses unable to be applied against capital gains may be used to offset income with all sources in the year of death and the immediate year prior, subject to certain limitations. This is where your accountant becomes very important to make sure that he or she takes care of the taxes that are owed today and in the past. Us, as your financial planners, we take care of the taxes that are in the future.
So, as you can see, if you own these types of assets, depending on the increase of value, your estate could face a significant tax bill, hence making the Canadian Revenue Agency an unintended beneficiary of your estate. So, thinking about the heirs of your estate, right? What are possible solutions to cover this tax bite? So one of the best solutions methods is a spousal or common law partner rollover, as Terence mentioned just earlier. You can defer tax until your spouse's death, but the tax liability may continue to build while the surviving spouse owns the assets, if the asset appreciates in value. The spousal or common law partner rollover option doesn't solve the problem. It merely postpones the potentially growing tax liability. If your personal representative and your heirs decide to save the tangible assets of this estate from a forced sale, they must come up with enough money to pay the tax liability. So what are other options, Terence?
Well, those options for those who are looking at a tax liability that becomes with a forced sale, well, you could pay the taxes out of your own income. The heirs could pay their taxes out of their own income or assets. This would be done with after-tax dollars, assuming that they even have the funds available, making this an expensive solution compared to other options. Your heirs could also borrow money to cover the tax liability on your estate. But what are the terms of the loan, amortization period, and interest rate? Can your heirs afford this loan? Are they prepared to take on a huge after-tax loan repayment burden so they can keep the family cottage? Finally, third option that comes to mind is your executor could sell some of the estate assets to cover the tax liability, which is in most cases what happens. But such sales may attract an additional income tax liability. Sold assets are gone forever. And forced sales can cause serious losses. So if you need to sell something and it's a low point in the market, your hand is forced, and you may not receive a fair price for those assets. Stop and think about this and ask yourself, is this what you want?
There are many solutions. Like, for example, you may wish to use a last-to-die permanent insurance to provide tax-free funds upon the second spouse's death to offset the estate liabilities, including tax on capital gains. Last-to-die insurance would insure both of your lives under one policy. That's your husband and wife situation, and the proceeds would be payable on the death of the second spouse to die. The premiums of this type of insurance is considerably less expensive than premiums for a single life permanent insurance, insuring only one of your lives. This is also awesome for those couples with one spouse facing challenges getting insurance at all. It's a viable and commonly used strategy to the tax liability problem, as it creates ready liquidity. Very important. And this guarantees the future delivery of a certain amount of money.
With a great financial planner, your two financial gurus, who are a licensed insurance advisor, will figure out those numbers so it doesn't have to be a daunting task for you. Once you have those numbers, choosing the appropriate permanent insurance for you to cover taxes owing, then you've got that covered and no one has to scramble for expensive solutions. And remember, the price of life insurance, it will never be less expensive than it is today. Why? As we grow older, the cost of new life insurance increases. The earlier permanent life insurance is purchased, the lower the cost will be.
By now, it should be apparent that you need to put some serious planning around your estate taxes. Who needs this type of insurance? Well, this strategy is designed for individuals who, for example, have an annual tax obligation from non-registered investments. Again, I repeat, non-registered investments. That's anything outside an RRSP or TFSA, RRF. Any strategies designed for individuals who have a desire to reduce taxes on investment income. This is designed for people who want to leave an inheritance for their heirs and for people who want to control their legacy.
That's right. Okay, we're going to leave you with your action item. So if you're going to leave money behind for someone else, including a charity, your financial guru has a duty to make sure that your money goes to your heirs in the most efficient way possible. In order to do that, you need to have an estate tax analysis done with your financial planner and possibly your accountant. For those who are the heirs, for those of you who are listening who are the heirs, your action item is different. And I would consider it your duty is to make sure that the people who are leaving the money behind have a proper estate tax plan in place. Parents, grandparents, business owners. Again, you have the choice when dealing with estate taxes to either pay the government or your favorite charity. Because when you designate a registered charity as the beneficiary of a life insurance policy, for example, your estate will receive 100% tax-deductible receipt. What we, as financial gurus, do for our clients is calculate what your estate tax bill will be and insure it now so that the payout to the charity in the future will completely cover the final estate tax bill. It's a win-win-win for everybody, and the only one who loses is the taxman.
Finally, The most important message we're sending out to you is if you have questions relating to yourselves and your own lives, please feel free to reach out to us. We are Terence and Ela, your financial gurus, happy to help out. You can write to us, as we mentioned before, at 2financialgurus, the number 2financialgurus@gmail.com. Give us a call, 778-879-0820. And leave us a message there if we don't answer, but we will be because we're waiting for your call. And then you can certainly check out our episodes off the Facebook page that we have called Dollars with Sense. Super easy to find. And then finally, you can watch this episode and 40 other phenomenal episodes on our YouTube channel. Just put Ela and Terence in that search bar and you'll see it pop up right away. You can hear again this one or any of our other wonderful episodes that we're dedicating to you guys out there to help you with your financial needs. Thank you, everybody, and have a great week. I'm Ela Lange, and my co-host, Terence Vanderwood, appreciate you joining us today.
And may your dollars and cents be with you.